Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hi, all. Welcome to Business Line's year-end podcast on the banking sector. The banking sector is expected to end the current financial year with a moderation in credit growth in the backdrop of slowing economic growth. Moreover, RBI's November 2023 measures, increasing risk weights on unsecured consumer credit and bank credit to NBFCs, is also tempering credit growth. FY25 started with credit growth outstripping deposit growth. While year-on-year credit growth at the beginning of the year was at about 19.5%, the deposit growth was lagging at about 13.5%. This prompted banks to increase deposit rates and tap short-term certificate of deposits in a big way to bridge the credit deposit gap. As on November end, the credit growth and deposit growth has converged, with both growing at about 10.6%. The sector's asset quality, as measured by the gross non-performing assets ratio, is at its best since March 2011. The ratio was at 2.54% of gross advances as at September end 2024. To tell us more about the sector, we have with us Mr. Karthik Srinivasan, Senior Vice President and Group Head, Financial Sector Ratings at ICRA. We welcome Mr. Karthik Srinivasan to Business Line's year-end podcast on the banking sector. Welcome, Mr. Karthik Srinivasan.
Hi, thank you very much.
In the backdrop of the Reserve Bank of India cutting its current year GDP growth forecast from 7.2% to 6.6%, how do you see the credit growth panning out for the banking system?
If you just step backwards and see, the banking sector has been growing pretty sharply over the last 2 years. The challenges on high CD ratios were visible last year itself. So from our perspective, we had in any case penciled a slower growth for FY25. Our initial estimates was about 11.5 to 12.5 kind of a range. But given the performance year till date and the fact that the GDP estimates have also come down, we're all likelihood to further, revise our credit growth expectations for FY25, possibly closer to 10.5 to 11%. A large part of it is clearly driven by slowdown on the retail and the services segment. And that's been the key driver for the banking system growth in the last 2 years.
And how well capitalized are banks to meet the credit demand in the economy? Will internal accruals be enough to fund this demand, or will they have to tap the capital markets?
See, from a regulatory capital point of view, banks are pretty well capitalized. Last couple of years, their internal accruals have also been improving. So clearly at the current stage, they seem to be fairly comfortable. You add on to the aspect that we are expecting a slowdown in credit. We're not going to see that 18, 19, 20% kind of growth that we saw in the last couple of years. So with the expectation of a lower credit growth, we believe banks are fairly well capitalized for the next 12, 24 months. The only thing that we would need to bear in mind is one, a lot of public sector banks still have government shareholding more than 75%. So, the regulatory requirement to get down the holding to 75%, SEBI has been giving them extensions, but to that effect, you could see some capital raise. The other couple of things are, some of the regulations which are still in draft stages. How do those pan out? That would possibly, decide on the quantum of capital raise. Notwithstanding that, I guess the equity markets are still robust, so shouldn't be surprised if few banks are actually looking at a capital raise, given that the current market multiples are pretty good.
It has been over a year since RBI increased risk weights on unsecured consumer credit and bank credit to NBFCs. What impact is this having on credit growth in these segments?
Clearly, the credit growth to NBFC sector has slowed down quite significantly. If you really look at the sectoral deployment data from RBI, the October data seems to suggest that the YOY credit growth for NBFCs has actually come down to about 6%. as compared to high teens and possibly 20% plus over the last couple of years. So clearly the slowdown is visible. It is more pronounced on the unsecured segment, and incrementally, if you were to look at the banking exposure to NBFC as on date, is actually lower than the March 24 levels. It's just that on a YOY level you still see positive, but clearly there is a marked slowdown on bank lending to NBFCs. Part of it, one can say that with fall in interest rates during the course of the year, some of the stronger NBFCs have also moved to the bond market. So that has also helped, and in terms help the NBFCs in terms of mobilizing funds, but purely as a bank loan exposure that has come down over the last 12 months.
And except for the industry sector, credit growth in the other three sectors, that is agriculture, services, and personal loans, have seen a year-on-year moderation in October. What is your reading of this trend?
One, it is seasonal. Second, if you were to look at services sector or the retail sector, both are predominantly sectors where one has seen slowdown. Banks have been a bit more risk averse, expanding those portfolios cautiously. So that's the reason one is really seeing some slowdown out here.
Earlier, there were concerns about widening gap between credit growth and deposit growth. But now the two seem to be gradually converging. What are the implications of this in terms of margins for banks?
Margins for banks in general, before I come down to this gap via narrowing, margins for banks and for that matter even NBFCs, one does expect that to shrink. We're already seeing compression in margins in Q2 numbers. We believe that should continue for some more time. The reason being, it's difficult to mobilize deposits by cutting rates. Banks, all said and done, are still having some challenges in mobilizing deposits. So your deposit rates are not really going to come down immediately. On the other hand, there is an expectation of rate cuts sooner than later. A proportion of the portfolio is linked to external benchmarks, T-bills, repo rates. So clearly, as and when those events materialize, banks will start feeling the pinch on the lending rates on those kind of market-linked benchmark portfolios. But the extent to which the impact would be there could be different for different banks depending on what's their asset and liability mix. The other way to look at it is also, if I was to give a completely contra view, with credit growth slowing down, banks need not be aggressive in mobilizing deposits, right? So they can still keep their deposit rates where they are and then try to protect the margin as much as possible. But clearly, to cut a long story short, a high possibility that there will be compression of margins. Extent would possibly be dependent on a bank case-to-case specific basis.
Now, in the face of better returns from alternative investment avenues such as stock markets, bonds, is there anything banks can do to grow their deposits? Or are they doing anything to shore up their deposits?
It's possibly wrong to suggest that because of alternate avenues, money is moving out of the banking sector. Our belief is money is still there within the banking sector. Even if I was to invest, let's say, in a mutual fund or an AIF, where does that money go? It comes back to the financial system, it comes back to the banking system. Not as a retail deposit. I would have possibly put it as a retail deposit. Now, through the mutual fund route, through the AIF route, or through other route, it is coming to the banking system as a wholesale deposit. So you can say that the color of deposit is changing from retail to wholesale. That has other implications. For example, the LCR norms, how does the runoff happen, runoff assumptions on LCR. So that's a bigger challenge for banks, not really that money is going out of the banking system.
And do you see the banks tweaking the way they do business in view of the expected revision in the liquidity coverage ratio?
Yes, that's clearly something which is going to happen. Today, a lot of banks have, significantly higher levels of LCRs as compared to what RBI has stipulated of 100%. So a couple of things will happen. One, they may want to reduce the extra cushion that they have over the regulatory levels. For example, if somebody was having an LCR of 120, maybe they decide, okay, let's not operate at 120, but we'll operate at 110 or 150. So that's one change which can happen. The other change which can also happen is maybe now the banks would try and focus more on retail deposits, because you can still maintain your retail deposit. As I just said to the earlier question, the color of deposits, impacts the assumptions on the runoff. So there could also be a focus by banks to improve the retail deposit mix within the bank, which can help them not only in the overall mobilization of deposits, but also on the LCR front.
See, monetary policy is widely expected to cut the repo rate in February. So what will be the effect of this on lending rates, deposit rates, and margins?
As I said, when you have the cut in the benchmark rates, the transmission would happen faster on loans which are linked to repo rates or something. But if it is linked to MCLR, those will probably, transmission will happen with a lag. But clearly with a possibility of rate cuts happening sooner than later. But if I was to say inability of banks to immediately cut down on the deposit rates, clearly high chances that lending rates may start coming down, deposit rates unlikely to come down. So you're going to see some pressure on the interest margin for banks.
Now, considering that in a special mention account 2, the ratio, has flattened out. Yeah, when you see the September level going by RBI data, do you see some kind of pressures that are building up incipient stress in the banking system?
See, there is some stress which is building up, but it doesn't get completely captured on this data that you're referring to. For a simple reason, this data is generally a compilation of accounts more than 5 crores.
Yeah.
Right. Whereas if you were to just look at where are we seeing stress today, it's more on the retail portfolio. It's more on the SME portfolio where the ticket sizes are not above 5 crores. So, and that if you were to look at, the bank results for September or NBFC results for September, clearly you are seeing signs of delinquencies go up, NPAs inching up. But the balance sheet of banks is strong. Their operating profitability has improved. We do believe they should be able to absorb any minor shocks out there. But yeah, so there is some stress building up, but we believe that the system is robust enough to sort of manage it as of now.
Can you give us an outlook for the next year, how the banking system will perform next year in terms of credit and deposit growth?
We're still working out our numbers, not fully worked that out, but clearly this year's estimates of about 10.5%, 11% on credit and possibly around 11% on deposits is the number that we currently have for FY25. More or less would be in the similar range. Clearly don't see a situation where the numbers can significantly deviate from those levels, but a lot of things at play. Probably need to wait and see what the budget has in store for us. What does the new governor, what are his priorities, and what kind of stance the RBI now takes on a lot of policy decisions which are yet to get closed. So maybe it'll be a function of all those. But for now, I guess we're still holding on to FY25 numbers as of date.
Thank you so much for talking to us.
Thank you very much.
Thank you.